Okay, good evening guys. Welcome to another live trading clinic. My name's Steve Ruffley. So again, we're going to go through the Fed's decision tonight. It's going to be quite interesting, I guess, with the data that came out this afternoon. Let me just go through the quick risk warning, and then we can go through some charts and talk about the fundamental data we're going to get. So before I start, remember, spread betting and CFD trading carry high risk or capital can result in losses to exceed your initial deposits. It might be suitable for everyone, so please ensure you fully understand the risks involved. Now, the information comments provided here under no circumstance are considered an offer or solicitation to invest. Nothing here should be considered investment advice. The information provided is believed to be accurate to the date it is produced. Again, educational only content on the webinars posted by moderation on intro.com. The content does not constitute financial investment or tax advice. Intro.com is not accepted any liability of the content consumed during the session. So what's it all about? Well, we're going to go through, obviously, this fundamental data tonight, which is all about the Fed decision, any kind of forward guidance, and what's going to be the kind of fallout, I guess, if any, which I doubt there will be, from the data that came out this afternoon. I'm going to go through the multiple time frame analysis, the way I trade from top to bottom, and I've got the account open. So again, a lot of people are expecting unchanged, as is the market, but as I've demonstrated many, many times with the Fed and the Bank of England, that it's always the unexpected ones where there's an opportunity to make money. So just because the majority of analysts and market participants say that there's going to be no change, therefore no trade, well, I mean, it's generally you kind of sat on the wall market commentators that say no change and won't be trading, unlike Steve Ruffley, who is always here, always trading, always doing stuff, always being here live, and I certainly do not stand on the fence. So I'll tell you my kind of thoughts, and I'll tell you why in a second. So interesting how the markets have reacted to that CPI data today. So expected 0.0 with a fairly tight range, it became at a minus 0.2. So immediately all the analysts have come out and said that that's obviously going to have an effect on the pace and the rate of interest rates and when they're going to change. So I don't really know where they've got that from, to be honest. The whole point about why we've kept quantitative easing for so long and why we've kept a very kind of level ship is that we don't want to scare the markets. But as we know, quantitative easing is going to end next month, so that'll be the last time that the Fed injects money into the banking system. So nobody knows, and it doesn't matter who they are, from Bloomberg, Reuters, Financial Times, probably to the people in the Fed themselves, the exact effect this is going to have. So nobody knows. If they say they do, they are lying. So when you've had that kind of stimulus and that kind of support within the markets, when it's gone, the market has to be self-sustaining, and we'll hope and pray that that is what the markets can do. But again, we have to be set for success, brace for failure. We never actually know what is going to happen. So with the CPI coming out weaker than expected, that's brought a lot of people to say that, well, actually, the state of inflation isn't that bad, and what we're going to do is be able to take that little bit of a step back and choose when we increase rates. Now, choice is a bit of an interesting one. Interest rates move in cycles, and the choice of when we start to increase interest rates is to some extent in our control. But realistically, the market, again, is always one step ahead of us. So it's all about what the market perceives the interest rates to be. And that's why we have futures markets. So every single comment, every single rate announcement, the market is pricing in when this inevitable, and it is inevitable, rate hike is going to be. You've listened to me on FX Street for any more than 6 months, 12 months a year, the 3-4 years I've been in FX Street, over the last 12 months I've been talking about the UK being the first of the G20 nations to raise interest rates. And they are, and they will. As soon as the UK do, the Fed are not going to follow suit, but the Fed will have to, again, come into that cycle, where they start to raise interest rates and normalise the economy. They've already done that, and they will have done that by the end of October by getting rid of quantitative easing. So we've got November, December, and to get into the first quarter to decide when the interest rates are going up. I've read many things, as we all have, about when this can happen. And there's certainly different economists out there saying that what's going to happen. Now, the general consensus seems to be that interest rates are going to be round about 1% by 2015. Okay, so we're expecting a hike in 2015. It doesn't necessarily mean it'll be the first quarter, but by the end of 2015, we're expecting them to be around about 1% in the US and probably 2.5% at the end of 2016. Now, these vary. Okay, you've got other analysts, extreme analysts, saying that there won't be a rate hike until 2017. Don't know what planet these people live on, but good luck to them. I would say, really, for me, it's going to be the first quarter for the UK. I've pretty much been out and outspoken saying this, and I'm going to stick by my guns. And I do believe that in the first quarter we're going to see a 25% basis hike in interest rates. I don't believe it'll happen so quick in the US, but I think certainly by the second or third quarter, we're going to see a quarter point rise as well. I mean, again, that would tie in nicely with the analyst predictions that we're going to see 1% by the end of 2015. You just don't know. I mean, again, once you start this tightening cycle and you start to hike rates, you can't go back. No matter what anyone says, you're going to have to keep with the pain. We know with the debt borrowing, the mortgage burdens, we know with the way the general economy is, that we're going to feel pain. Okay, everybody expects that. An interesting comment that I was reading about the Scottish independent referendum and the yes vote and how it might affect Scottish people is that lending rates are almost certainly going to go up because of the insecurity of a new country. And 1 in 5 people in Scotland say they can't afford their mortgage rates if they go up by more than £50. Okay, £50 a month. So that's how close and tight people's living standards are. So if you're talking about Scotland, 5 million people, 1 in 5, 1 million people that can't afford more than a £50 increase, well, your 0.25% takes that to a whole new level. That's your mortgage, that's your cost of living, that's your your credit card, any debt payments, any one of them things is much more, or going to be much more than that £50. So, going to be interesting. I guess, a lot of uncertainty still in the market. But what is for sure, at some point in 2015, the world's going to have to start getting back on track and having normalised interest rates. They reckon in the US alone, it's cost savers over $1.2 trillion. Okay, we're an aging population. People are retiring early. The people who are retiring early, the people with money. Okay, there won't be that many people retiring in 10, 15, 20 years at 50. That's for sure. But the amount of money that's in the system right now, there's never been more money in the economy. Never been more money printed. So we need to normalise interest rates to bring back borrowing and have a steady economy. We can't still keep fueling our growth on that cheap money and that consumer spending. It's unsustainable. So really where we are now is it's going to be pretty much, as having said all that, it's going to be an unchanged decision today. I'm fairly sure of that, as are all the analysts. But it doesn't mean there won't be a movement in the markets. I've proved again, time and time again, that something may be said. And again, there's a press conference after this, which I'm not really going to perhaps stay around for, I'm afraid. But the news conference is going to really perhaps push Janet Yellen into some proper forward guidance. We haven't seen it from Mark Carney of the Bank of England, and who cares what Mario Draghi says, in all fairness. The guy's absolutely clueless. He's not going to clue what he's doing. So Janet Yellen, she's a level-headed woman, and I do respect her, and I think she's got a difficult task ahead, but I'm sure she'll be fine. But what I do think she needs to do once and for all is bring some forward guidance into the market and stop this guessing. So is she going to say it? Who knows? It's going to be interesting to say. But we've seen that normal volatility, before the kind of rate announcement. We've seen that the pound against the euro did strengthen a little bit against the dollar after that CPI reading, but now it's sold off. The euro again, very, very, very choppy, very volatile. Made some highs, then immediately made some new lows. And the S&P had a nice sell-off. And gap down towards the lower bowls, and is now trading back to the moving average. So all in all, we're pretty much trading where we were this morning. So not a great deal of kind of market direction. So what's the main kind of thing to look out for right now? Well, the main thing to look out for, I would say, is an indication of any kind of fear in the market. Again, any kind of indication that the data that's being produced, today, and non-farm payrolls coming in the next few months, if that's going to have any effect on policy decision next year. I don't really believe it is. Governments are like, slow-moving ships. You can't just put the brakes on and expect them to stop. So we've come to a very, very important time in American history where we've come to the end of quantitative easing next month. So that really is good. The Fed's going to need a couple of months and see some data to what actually happens, to what impact that really has in the US. So that's going to be the key telling point early next year. If there's no massive visible signs of the lack of quantitative easing hampering the markets, then that is going to be the green light for rates to hike. And as I said, guys, once they go up, they're going to continue to go up. I'd expect by 2018 that we're around about 5%. Okay, so interest rates have to go up and be normalised. And we're all looking at 5% like it's, 5%? Oh, you're mad, Steve. You look at when people were buying houses back in the early 80s, interest rates were at 14%. Okay, so 5% is absolutely doable. And remember, the longer we've had this tightening cycle and this, controlled economy, the longer it's going to take, for these things to unwind. So 2018, it's only 3 years away. Maybe it takes till 2020 or beyond. But one thing is, as soon as interest rates start to go up, they're not going to go down anytime soon. And I don't think for another couple of generations we'll ever see interest rates as low as this. And if we do, then that means the world's in a bit of trouble, to be honest, guys. So we've got 5 minutes or so before the before the announcement. Is there any products anyone would like to go through? I'm just going to focus on the euro dollar, on cable, and the S&P 500. So just a little bit of an indication of what we were looking at earlier, the CPI data. So this Fibonacci is actually from the 5-minute chart. So the Fibonacci is from this 5-minute extension, that we saw just after the CPI data. So the euro gained, pretty intensely against the dollar. So that went up, 12, 13 ticks, right up to 22 ticks, that initial spike. Then we came back down time and time again. As I say, that 50% is going to be the pivot. So when the market then really kind of retraced and came back down, the market really finally tipped its hat here and said that really when we closed below that 50%, a new low was going to be made. And we did. We went all the way back down to the 261 spot 8 Fibonacci. So again, that was really the trade. If you wanted to make some money, it was staying short around that 50% and getting out of these lower levels. So 26, 27 ticks to be made. So that's just an indication of how the market's moved within that 5-minute chart. So again, just put that back into your hourlies, and we can see how that significance is. We can see on the hourly charts how we pivot around that 50%. So really, got to the lows, got to the highs, we're really trading at that 50% now. So realistically, the market can carry on this up direction here. Yeah, and the euro can continue to strength, or it's going to again hold below that 50% to make new lows. And really, look at the trend. It's quite clear that the trend is down. So as long as we're below the midpoint of this bar here, then certainly new lows are going to be made in the euro. I think we're just consolidating now. I think we're all in agreement that, again, as I've been saying for 6 months, the euro is finished, and in the next 5 years to 10 years, the euro will split in two. Okay, so I think that by the end of the year, we're going to be resting round about maybe 116, maybe 115. I think the euro's got a long way to drop yet. Okay, so a long way on the charts to go down. Pound against the dollar, again, we've got the same scenario, how the market, again, went up quite aggressively against the dollar, held that 50% here, again, and then, again, make new lows. So, a little bit of relief selling, I would say, in the pound. The whole reason why people are saying the pound is going down is because of the Scottish referendum. It's not. We've been selling off for 3 months, but prior to that 3 months, we're at a 6-year high. That's why the pound is selling off, okay? All the institutional traders have been buying for the last few years, anticipating interest rates to go up, as I have, and now they're cashing in, selling in, while the retail traders are getting into the market. So retail traders going long because interest rates are going to go up, institutional traders are selling because they made the profit. That's why it's going down. Don't get me wrong, a little bit of fear is creeping into the market because of the Scottish thing, but it's only uncertainty. The pound's going to be around, the pound's going nowhere, that's for sure. So, again, a little bit of weakness coming to the pound now, could indicate something on traders' minds. And then we've got quite a bit of strength coming back into the S&P. That gap seller for now going up. Okay, so we've got a minute or so before the announcement. Doesn't mean that anything's going to be changed just because the market's moving around right now. What I would say is that the movement really is probably people liquidating positions and just getting out of things before anything was said. Because if anything was said today, well, we're going to see an unbelievable move. So just a minute now before it comes out, guys. Unchanged is the call, but I mean, it doesn't matter that it's unchanged or not. Let's see what the markets do. There's still an opportunity to trade. So I'll keep on the hourly charts. As soon as it's out, I'll flick on the 15 minutes, try and see if we can see any intraday kind of opportunities, and maybe a little cheeky sell of the S&P at these higher levels. Okay, 30 seconds or so, guys. Just watch that S&P. 10 seconds, guys, till the announcement. Okay, big gap up in the S&P though, and immediately sold down, unchanged. Labour market improving, so good news coming out from the Fed here. Markets going a little bit crazy in the S&P. Look again, very, very careful, guys. So the 10 billion, as expected, is tapering the bond buying. So the current status and the policy is appropriate. Okay, inflation's below the long-run goal. I mean, watch the S&P now retracting quite aggressively, guys. You know, big coming back into the pound. Euro, watch that euro. Euro spike very aggressively down. 1.28911 could be a potential bounce back. So, negativity from what's being said, I guess, weighing on the S&P. But I'm not entirely sure why that euro spiked down so much, guys. Watch that lower level. Watch that lower level. Pounds now taking the lower level. 1262602 is a good potential bounce back buy level. Okay, so S&P, pound, euro, all coming off, guys. All coming off. S&P again. Look for new lows to be made. 1994 spot 11. Okay, that's where a low in the S&P can potentially be if we break these lows here. Okay, so mixed bag out of the Fed there, really. Certainly the market's taking the initial comments positively, but certainly then reversing. Really everything seems to be on track, but I think the underlying message is that inflation seems to be a bit of a problem. If inflation's a problem, then interest rates are probably going up sooner than we think, okay? And sooner than the market anticipates. So that's why we're seeing, you know, some negativity in the S&P, and we're seeing, again, a bit of a movement down. So could be a low level here in the euro-dollar to buy. This is a real low in the euro-dollar to buy. Below that we've got 128593. So a little buy in the euro dollar, a little buy going long the euro dollar. So again, you know, normalisation is not going to begin soon. That's another contradictory comment coming out from the Fed. So again, maybe meaning that we know we're not going to hike these rates as quick as people think. That's really why we need this forward guidance, guys. You know, it's really unfair, you know, by the Fed to keep the market guessing. So more downward pressure in the S&P. Look for this 1994 spot 11 level. Okay, this is going to be the low point. It's definitely a good buying opportunity because you could average into 1991 spot 70. Okay, so onside in the euro dollar bounced perfectly off the level that I stated. So again, if it starts to come back down, guys, you know, again, just get out for a quick profit. There's no point being a hero. 126202 in the pound against the dollar in cable. That's a good level. Nothing below that though, guys. So if we do break that through that aggressively, could see some big paper coming up to a buy now. Buy in the S&P. 1994 spot 11. Buy in the S&P. Okay, going to hit it again. So if we break through, potential average and at 1991 spot 70. Okay, wow, yeah, it's gone right to that level, guys. So just averaging by a little bit more. If it continues down, we'll have to get out. No, see, there we go, guys. Good levels. Okay, good levels. Profit taking, come on, profit take. Yeah, there we go. Perfect trade. Get back to these upper bowls. Okay, aggressive moves here, guys. Aggressive moves. Okay, taking some profit in the euro dollar now. So I'm going to take it back at that 423 lower level. We've already taken half my position out in the S&P, so because good job we bought quickly back at that 199 spot 70 level. So profitable 2 in both of them trades. Low still to be hit in the pound against the dollar. This 162602 level. Okay, on the 15-minute charts here. So you know, again, some of these moves are a little bit bigger than they are. But when the S&P getting back to 1998 spot 16, it'd be nice. That'd be a nice trade. Back towards the low nows in the euro dollar. So a break of the euro dollar gets down to 128593. So generally seeing quite a lot of strength against the dollar here based on them comments. So again, just goes to show, don't need anything to be said that inline figures are don't do anything to the market. So lows, expecting lows now to come into the euro dollar. Again, test that level 3 times now. Fib's working well. Fib's working very well on these hourly charts. So 12.29 for gold. So again, gold's just taking a bit of a bid off that news. So low's been hit in the euro dollar for now. Again, holding on them fibs, that lower 423 retracement on the 15-minute chart on cable. Again, coming back up now with the S&P. So we've still got half a lot left in this. So we need the upper Bollinger Bands to be nice, because if we get a quick snap back, I'm going to take it at 1998 spot 16, this lower level. So difficult trading, but again, you know, that whole point of having your levels in beforehand is to be able to get in and out quickly. That's what it's all about when we're trading. You know, get in, get out, take that profit, take it off the table. Okay, because this is going to be a nice trade in the S&P. We're going to be from that low here to here, you know, 53 ticks. You know, that's a good trade. That's a nice trade. Okay, so real retracement back in the pound. Again, we bounced off the lower levels, didn't get to them lower weekly levels in the pound. So again, only another few little pips ticks up. There we go, out for profit, out for profit. Okay, done. So that's a very, very good trade in the S&P. You know, I told you what the market was going to do. Broke to here and had to go down aggressively another 23 ticks. You know, 28 ticks, sorry. So a very, very aggressive trade. But I told you to buy more here. So you've averaged in, and that's 77 ticks profit. Okay, we've bounced off the low level in the euro dollar. I'm already out at the 423, but again, we've already kind of moved for the lows and the highs quite nicely. So again, a nice bounce off that low level of 34 ticks. Pretty much retraced, you know, completely in the cable. Not really the trade. I wasn't calling anything there, but we didn't hit the lower level, and moving back from that lower fib level, a nice 16 ticks profit to be had. So yeah, money to be had there, guys. Money to be had. You know, again, the absolute benefit of having your fibs and your lines and your levels that you trust in, you know, what to buy. And I knew this was the low end, so I knew the market was going to aggressively push down, get them retail traders out, as they did. You know, I can demonstrate it, you know, quite easily a number of times, you know, when we talk about, you know, what the retail traders want to do, what, you know, and everyone's going to be buying down here, these low levels. And again, this 423 spot 6 fib is always perfect, so you look to buy the next level. That's when the market's moved. There's no way they can get it down to 1985.5. So you buy a 1944.11, buy more at 1991 spot 70, buy it back at the next fib level. That's how you trade. So a little bit of weakness coming back into the pound. I know not that anything's finished by any stretch of the imagination yet, but again, the profits to be made. You know, profit made in the euro dollar, profit made in the S&P, all on the back of an inline figure. So it's all about the comments, all about the things that come through, and the market's expectation, guys. The market's, you know, what they think is going to happen. Okay, guys. So how did you guys get on? Did anybody buy any of them levels? Did we get involved, guys? Is anybody long or short beforehand? Again, I think we'd all like to be saying that you know, it's a lot easier said than done, and it's certainly not. But again, the whole part of my whole ethos of trading, you know, my 80-20 rule, the markets move 80% of the time technically, but 20% of the time fundamentally. When them fundamentals come into the markets, you have to know your technicals. You have to know them exactly, because these are the things that are going to make you the money. If you don't know your technicals, you won't have the confidence to trade them. Okay, so Alan's been short the euro dollar since the news spike this afternoon, closed at 129. Good man, Alan. Well, that's the trade you want, isn't it? Okay, so again, great level. So you had the perfect out that I called in the euro dollar. That's been the low so far anyway. Pound's still looking a little bit weak here. So we know that if we break this lower level at 162.602, then there's not a great deal below that until 1602.520. So we could see, you know, the pound getting a bit of a tanking here. I don't think the news today really is strong enough. And again, you know, the kind of underlying tone that I've got is that, you know, the Fed are probably going to wait a little bit longer than the market expects for, you know, to raise interest rates. But I think again, it's just another daily manipulation, another hourly candle, 15-minute candle that's going to get bounced around by there being no real news. There's nothing really surprising the markets here. So we're going to see a range, you know, in this 15-minute candle in the S&P of, you know, 140 ticks, and it's not really warranted, because as soon as at them lows, the market was scrambling to buy back and push it up higher. So again, towards the lows in the pound and the euro dollar. The euro for me, I just keep selling as much as you want. You know, it's finished anyway. So below this 50%, you know, we're going to get, again, as I showed you, at the fib levels in the S&P, how they work. They're going to work in the same way in the in the euro dollar. So below this, as long as we start closing below these fib levels, yeah, then we've got this really big daily, weekly level that's going to come into play, and then below the 261, below that, the 423. So nothing down to one spot 2744. So we've got a long way potentially to fall in the euro dollar. We've got another 59, 150 ticks, which I can easily see happen by the end of the week. As the further this euro falls, the faster it's going to start going. And again, news like this and data that's pushing it down is what we're looking for. So we can even make new highs in the S&P now. I wouldn't be surprised if we go green and we get up to 201240. Again, as soon as we go green in this candle, you're going to see a massive attempt to push back up. That's why these moves, these candles are so very hard to trade. In a 15-minute candle, you've been winged around 140 ticks. So we've actually bought, now the low in the S&P. Okay, so we got out at a good level. We could have held on for more, but it's not about being greedy. It's about getting in, getting out. Okay, it's not about being right, but being right at the right time and banking that profit. Okay, when can we have a correction in the euro and the pound? What levels are in play? When to short the euro now after this mess? Well, again, guys, go back to your higher time frame levels. So we're looking at the daily chart. The time to sell was down here when we broke these lows. At 133. But where to sell now? Well, we're kind of consolidating now. I'll just start from a blank chart. We're in no particular rush here. So what we've seen is the market move aggressively down. So what we'd like to do is find value. So the value is now from the low to the high. Well, look at that 50%. That 50% is the tops here. So realistically, if you start going short any time in this consolidation period below the 50 and below the 23.6, you're going to have a chance to be able to get short and stay short. Because what's the next wave going to look like? Okay, it's going to look like this, isn't it? This is a daily chart. Daily chart, consolidate. If we can't go up, then we go down. So the market consolidates and carries on down like that. So I'd say you've got a nice window between that 50% at 13003 and where we're trading here at spot 29193. You've got a chance to build a short position anywhere between these levels and let the market break down, because your target for a breakout will be the low of this candle here. So what we're trying to do is build up maybe a position over the next few days with our 90 tick stop. So if you're running a 2-to-1, 3-to-1 risk reward, you've got a 90 tick stop back at these highs, then you need to make 290 to 270 ticks. So that's only kind of down here at the 126 level. So again, guys, do your Fibonacci. Again, another trick is to do your Fibonacci the other way. So do your Fibonacci from the low to the high, then you get them nice Fibonacci extension levels on the way down. Now I guarantee, this is the beauty of Fibonacci, guys, that isn't going to be too far away from 270 ticks. Okay, 180. Okay, so not as close as I would like, but again, it's still a good indication. If you're taking 90 ticks, you can make a couple of hundred ticks on the way down. So that's your basic kind of 2-to-1 risk reward. So below that would be the 261. So that would be your euro down to spot 23840. So again, look, the S&P now has gone positive. This is going to be the target to the previous highs, 2012 spot 40. Again, that's an amazing shift in the S&P. We bought the low, and the market now has gone up, so I come in 147 tick winner. Okay, so again, we still banked over 50 ticks, which is more than enough. So they're kind of levels I would say if you're going to start to get short on the daily or higher time frames, you want to be staying in the regions between 130 and 128 and a half, building a position around there for possible breaks then to 126, 123. Okay, so the pound, a little bit more tricky, but if we go into a blank chart and I'll show you how this kind of Scottish referendum is just blowing things out of proportion. Start selling back here. So big sell-off in 2006, down to the lows. Where's that 50%? It's here at 173. So the institutionals all buying on this trend line. Because institutional traders know that interest rates in the UK will probably go up first. So every low point, they're buying, making higher highs, getting strength in the chart towards that 50%. So that means now, when we're talking about the Scottish referendum here, yeah, the market's already peaked. So any kind of fear brought into the pound, because of the Scottish referendum, just means that it means institutional traders are liquidating. Okay, that has nothing to do with Scotland. Okay, so we're going to get down to these low points here and rebound. I still believe that the pound's going to strengthen quite considerably against the dollar, and expect 1.82 around that level before the end of the year. So again, if you want to buy, don't buy now. It's too volatile to buy. You want to be buying down these low levels, and I would say that certainly the market is going to look to get to this trend line. So what I'd look to do really is just buy above 1.529 spot 42. So we're looking for the market to hold, break that trend line a little bit, but not close below this. Get back to 23, back to the 50, act as support, then the market goes higher. That's a longer term trade. I see that happening over the next kind of 6, 12 weeks. Maybe next kind of probably till Christmas perhaps. But what you're doing is you're buying low to sell high. Okay, so there are your kind of levels in the in cable. So S&P now, I think we're inevitably going to see some profit taking. If you want to know what that's going to be, again, we'll just do an absolutely naked chart. We can do it on the 15-minute chart, because that's as good as any. So we're going to do it top to bottom, because we're expecting that the market now is going to go back up and make a new high. So that would work out like this. Market then gets to the 50%. Yeah, that's where the profit takers go. The market then bounces off that 50%, breaks the highs. Then we expect new highs to be made at 2015 spot 48, because we have no levels on the upside, and then 230 spot 39. That's how I would see. The longer we hold above the 61% and 50%, again, because we've rejected all this selling inertia, all this selling momentum here, hold above the 50 and 61.8, break them highs, and like I said, 215, 230 are more than achievable. Possibly, I'd probably say 2015 is more achievable than 2030 for sure, but you just don't know. These markets are still in a massive bull market. So look at the monthly chart. Okay, that's a monthly chart. Okay, when the crash comes, guys, and the correction comes, it is going to be a whopper. But right now, every time we've seen a low on the monthlies, you buy. Dip buying on the dailies. I called it in Reuters. Okay, again, these are the dailies. Every time you see a big spike down, the market buys up. Big spike down, close higher. Big spike down, close higher. Big spike, higher. Big spike, higher. Big spike, close higher. Yeah, dip buying all the way to them new highs, guys. Yeah, S&P stocks are going nowhere but up. Okay, so Steve, when can we have a quick look at the dollar CAD? Okay, sorry about that. I didn't see that come through. Have a look at it right now. So blank chart, dollar CAD. Same kind of scenario. We're seeing again, the market come down to these low points, then real strength come back in. So look on the higher time frames, monthly charts. Where's value? Okay, where's value? Value's here. About 50%. Where is it? We're at the 50% now. Surprise, surprise. Okay, so the 50% on the monthlies is going to be our pivot. Okay, so round about that one spot 10,672 level. Okay, so that's the framework. Let's go down to the hourly, see how that comes into play. Well, I would say that really what we're looking for now is a bit of a downward channel, I would say, on the hourlies. So what we're looking for is that real support to be held. So a nice downward channel. Market really is... Okay, so what we're looking for really now on the hourlies is the market to close outside this kind of trend channel. Now, you have to be a bit inventive with these things, to be honest. I mean, that's a nice, solid trend line, but we're going to give ourselves some boundaries. So I'd say in the short term, if the dollar's going to get that initial sell-off out the way and rebound from this announcement from the Fed, we're going to close outside this this upper band, and we're going to head to that 50% of the monthly. So realistically, I'd expect some strength to come in. So there's another 89 ticks. We've already moved 54 ticks, 60 ticks. So what we're trying to do is pick them bottoms and then look for the market to move a bit sideways, start a new trend, and come back up. Okay, so I'd say that realistically, on the hourly, let me just put a bit more clarification. That we've hit, again, look at these fib levels working. The 423 is acted as resistance on the way up. So what we're trying to do now is hold above this midpoint in the Bollinger Bands for the market to move sideways, get back into these fib ranges, and get back up to that 50%. So ideally, if the market and the dollar is going to carry on strength against the Canadian, we need to kind of be closing it above, I would say, 1.09600, and then look to find support on 1.09939. And if we do that, we've got every chance to get into spot 10854, which should be about 90 ticks. Okay, so that's what I think of the dollar CAD. S&P all-time highs. Yep, absolutely, Alan. We haven't heard that before, have we? You see a bigger picture chance to hit 1.27 first at the gap, 1.230, not to be closed maybe before in the euro dollar. Right, euro dollar. The 127.132. Okay, sorry, just let me. Well, I mean, when we start to get to the lows in the euros, I mean, I have to go to the dailies to look at that. I mean, realistically, you can see where the market's aiming for. It's aiming for these lows here. Okay, so this is where really the market wants to get to. And once it breaks that, we're going to get into these very low levels. And again, you're going to set these longer term stops off. So good lows here, here. Yeah, difficult. Okay, I would say realistically, we haven't got far to fall before we start hitting significant daily kind of lows and peaks. So I would say that really these fib levels are working perfectly. So we break that, the absolute target is here. So my fib levels at 126 and 123.840 are really where the market's going to go down to. So I'd expect the next kind of probably 2 weeks of trading, we're going to start moving lower, hitting these levels. Because again, once we break 120 in the euro, there's going to be an absolute raft of selling. Yeah. It's going to be absolutely carnage. The market's going to get absolutely pummeled. Yeah, we know we had the gap, but I mean the gaps are relevant back up there. At 132.50. The gap's gone. The gap's not in play anymore. The gap's way gone. So the market, as it hasn't closed that gap, it's going down. So we're getting into the 120s and below. It's not going to go up. Can we look at the euro Aussie dollar? All right, okay. Well, I mean, I predict a lot of things, Mr. C, but yeah, I mean, I've always said, I've absolutely been adamant that the gaps are going to be in play and the euros are going to go down. I couldn't have made that any clearer and haven't made it any clearer since the start. So, again, when we're making new ranges down below, the gaps are pretty much irrelevant now. Everything now is about this consolidation and the euro moving further. It's certainly not going to go up. I would say if it's not gone up into this 50% range on 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, but 15 days of trading, it's not going to do it now. So it can only go lower. Okay, only go lower in the short term. So what else were we looking at? Sorry, euro Aussie dollar. Euro Aussie dollar. Where are you? Euro Aussie dollar. Euro. Come on, Stephen. Yeah, okay, 1 second. Okay, Euro Aussie dollar. Euro Aussie dollar. Okay. So yet again, let's just start on a blank chart and try and find some value. The up move has been quite prevalent and strong over the months. Where's that 50%? It's here. So we've bounced off the 50%. So the market's got one of two options. It's either going to get back into this very big range from here, or it's going to continue and break back into this shorter term range. So I would say the down move starts here, finishes here. So really what we're looking at is a bounce intraday of here, the market to then get to here or break here. So it's just these. So really, this is what we're looking at now. The market's going to either settle and find some support round about 1.40327, yeah, and then the market's going to try and push through that 50% of the big move at 1.59984, or we're going to rest and close below this pivot point here, which is the high from here to here, and the market's going to get back to these lows at 1.161.07. Below that, we don't really see a great deal. We're making absolute fresh lows in the euro versus the Aussie dollar, so there'd be absolute carnage from the lows here, and the market would really kind of aggressively sell off. So my kind of real train of thought is, just looking at that very, very briefly, and that monthly picture, is that looking like we're going to maybe come down a little bit, bounce off this trend line, the market's going to hit back to 1599. So you just cycle through the weeklies. Again, looks quite nicely. We've closed above, that midpoint. Daily, again, had a couple of days, tested it, rejected it, gone back up. So if you look on your hourly charts for a bit of an entry, again, a little bit difficult because the curve becomes so small on intraday trading. What I would say is realistically, it's looking that we're fairly bullish on the hourlies. So really, we're looking for these intraday highs to be hit. Then once we get above that, we know our next target is that level up here that we have in the monthlies, that 159984. So potentially you're looking at risk reward wise, maybe 257 ticks downside to make 1,700 upside. So that's not bad. It's not bad going at all, is it really? So I would say that it looks a little bit like it's going to recover. I think the euro is going to recover against the Aussie. But remember, I'm massively long-term negative the euro against every major currency. So I'd be selling the highs. So I would stay away from that personally, but that's just the analysis, okay? These are your levels where it could get to. Yeah, 143.27 on the low side. Your pivot is 144.107, and your high point is way up there at 1599, okay? Okay, what else have we got? Want to know about the Aussie dollar, New Zealand dollar, right? I mean, it's going to look not massively dissimilar to these, so... Aussie dollar again, I mean, it's that same kind of scenario, but from the converse side, we've seen this big sell-off, but again, it's that 50% we're looking for. The market started up here, gone to these highs, and 50% has told us, yeah, the market now has held above that considerably. So we've got one or two chances now. I would say that really it's looking a bit tired, is the Aussie against the dollar. So if we start resting on these lows and this 50% here at 0.86857, then the lower point is 0.81, and then we're going to come down. I would say that if the market really was going to have tipped its hat and told us it was going to find good support and carry on this uptrend, I think it'd have done it by now. Okay, so the monthly chart's really looking quite tired for me. So look at your weekly framework, see how that works out. Well, weekly again, we're making lower highs. It's looking tired, isn't it? A little bit of a head and shoulders type pattern here. So I'd say your target is definitely these lows down here. Yeah, and that's a 50%. So yeah, I think the Aussie's looking very susceptible against the dollar, to be honest, on that. And in the short term, on the hourlies, well, pretty much in no man's land. But, again, lower highs. So I would say that we start to consolidate and move lower. If we start to break these lows here at 0.89799, then that's your target down here. So your kind of risk reward is 230 ticks to make 340 ticks. So not amazing, but again, if you find a good spot to go low when you get the momentum on your side, then we're going to see some aggressive selling. So there will be still people holding short, thinking all gaps is filled. Good luck with that. The massive down for a 50-bit profit. Yeah, absolutely. I mean, people... I mean, in my book, there's a whole section, a whole strategy around gaps. Gaps, there's two rules, okay? Gaps either continue in that direction and aggressively, squeeze people out of the market, or gaps very, very quickly correct and fill that gap. Traders don't like gaps. Market analysts, chartists don't like gaps, but they do exist. But you have to understand if it's a technical gap or fundamental gap. A fundamental gap trades very differently than a technical gap. fundamental gap will gap, go in one direction, and it won't retrace back to that 50% of the initial spike or gap. The where you trade a technical gap is that the market will trade, it will gap, it will either close or come back to the inception point, support being resistance, then continue. Okay. Right, guys. Well, I mean that's a lot of speaking. That's a lot of action happening just in that very small pace. I can't even speak. That small point in time. I would say that realistically, we could easily get to 2015 spot 48 in the S&P. As Alan said very rightly, S&P making new highs. Pound stabilised a little bit. You've got your levels to buy down here. I'll be buying low the pound all day long. Again, if you want to take these levels, guys, take a screen print and just look how the market reacts. Like I said, I'm never very far away with my calls and levels. And then the euro, seeing a little bit of consolidation and a little bit of a spike back, but yeah, 129.193. Once we break that again and then hit these lows, that euro is getting absolutely pummeled, guys. It ain't coming back, that's for sure. Okay, guys. Well, not often you see a bit of live action. That was over 80 ticks made in a very, very short pace of time. Again, averaging, starting with small size, is the nature of the beast when you're trading such volatile markets and fast-moving data. Markets move 80% of the time technically, 20% fundamentally, 20% just makes them move faster. That's why you have to be an absolute expert in your charts at fundamental data, because then prices are only available once. We had literally a matter of seconds to buy the low in that S&P, and that's what made all the difference, because most people are getting out here while it's broke down, and we're not. We're waiting, anticipating a buyback, and within a couple of minutes we're back here, the market's gone on to make new highs. Yeah, that's the difference between a winning trader and a losing trader, trading the fundamentals and technicals. Okay, any other questions, guys? You can always get me on my FX Street page, also on Twitter at Steve Ruffley. Anything else, guys, just Google me. I'm certainly not a difficult man to find online. I'd like to thank FX Street and everyone for turning up. It's been a pleasure. Spread the word, guys. Again, keep the interest up, and it's been a pleasure. Happy trading. All right, guys, take it easy.